All right, so welcome to chapter 13. We are going to be focusing in on mutual funds as investments as well as ETFs. We are not going to be really focused on real estate as an investment, although there's a few pages in the chapter that do so. Okay. So some basics. It starts off with what a mutual fund is. It's actually a financial services company that you set up an account, you put money in that account, and you pick out funds. There are certain funds that you can invest in that financial services company has, and each of those funds have different objectives based on what you want to do. So if you just want to make a little extra interest, but you don't want to have any risk, then a money market fund would be one of those types of funds a company would offer. If you're interested in earning some income, there might be some bond funds. There might be some dividend, income funds. If you're looking for investment opportunities in stocks or other types of things, there's a bunch of funds there that we're going to be reviewing. So financial services company that offers these funds to investors. You have to open an account, put money in it, and put that money into specific funds. You also have options today in actually buying a mutual fund through something called exchange traded fund. It basically trades on the stock exchange, and it tends to be it tends to track an index. It tends to track an index, whether that's the S&P or other types of indexes that have been created. EFTs tend to track indexes. They tend to be smaller, a little bit more narrow in focus, and they can be traded all day long, okay, through the day. That's a little bit different than mutual funds, as we'll see in a moment. I'm going to give you some new information on this pretty soon. There are over 9,500 types of mutual funds in 2017, according to your book. And at that time, there was almost $19 trillion of money in mutual funds. I'm assuming that's a US number. The global number is almost 55 trillion. So I'm assuming this is strictly a US number. The wonderful thing about mutual funds is that professional money managers are managing the portfolio for you, and you're benefiting from their expertise. That's at least the bottom line. You make money on mutual funds because they can pay dividends, they can pay interest, and any type of gain has to be given to the owners of the fund. And that's because all mutual funds are pass-through entities, which means they're organizations that are owned by their shareholders. And so any benefit to that organization must pass through to their shareholders. So big questions as to why invest in mutual funds. They're very, very popular for a reason. Okay, you probably saw that last figure on the last slide, 18.7, almost 19 trillion in 2017. Well, back in 1990, they just were at a trillion. They were just at a trillion. So why are they so popular? Why invest in mutual funds? One big reason is that you're buying with other investors into a pool of investments. You're buying shares in a fund. The fund owns a whole bunch of other investments. It could be stocks only, could be stocks and bonds, could be all different types of things, stocks, bonds, and cash, money market. So you're buying into that. So you become a shareholder of the fund, and that fund owns a whole bunch of, say, stocks in it. So by default, you become part owner in all of the stocks in the fund. So that's a diversification because you're not buying one company stock. When you invest in a mutual fund, you become part owner in all the stocks that are owned in that fund. And that diversification means that there's less risk for you. Another thing is a lot of people can't manage all these things. I mean, it takes a lot of time and expertise and energy to pick out individual stocks and individual bonds and to make your investment moves. Mutual funds are already professionally managed. They have full-time expert managers, researchers, and others, analysts that already look for the investments for you to put in the fund. So it saves you from being, in essence, a specialist in investments because you can hire the fund to do it for you because it has professional management. Because you're actually taking less risk because of that diversification here. Your returns are actually higher. Your returns are higher. And so less risk and more return is really what investors, it's an investment dream, right? Why take the risk for the, if I had to take X risk to get Y return, well, investing in a mutual fund is X minus 1 to get the Y return, less risk. So why not? Right? And so it's a benefit there. It's very, very convenient because everything is handled right through the mutual fund company. They keep track of all the paperwork, the tax issues, et cetera, for you. So you don't have to figure all that stuff out yourself. They do it for you. There's a big but here. And I like big buts, and I cannot lie. But this particular but means that you really have no control over what's in that particular mutual fund that you're buying shares in. You've given that up to the expert managers, okay, for that. Mutual funds, is one of the other important words here is it's a pooled investment. So the other time we've talked about pools has been insurance. All insurances are pools of money to reduce risk. Mutual funds work on the same theory, that as a pooled investment, there's less risk for the investors. So they are very, very popular in that regard too. And there's another concept and how it's connected. So mutual funds are basically separate organizations, and strictly owned by their shareholders, but they are controlled by whoever is the fund manager. Okay. And like the last slide said, there were well over 9,500 different mutual funds. So those are each considered a separate organization owned by shareholders. There's a lot of folks that are involved in all of this. There's the actual management company. The mutual fund, as a management company, runs the operation of the funds. There's actually the investment advisors who basically are overseeing the stocks and bonds in those funds. There's actually a company who actually sells the shares. Those are the distributors. And so they're part of that. There is something called a custodian. They basically keep the assets, and so in safekeeping for the investors. And so most custodians are typically like a bank service that are held in there. And there's a transfer agent, which basically executes transactions, maintain the records, but basically they're record keepers. Okay. And so all of these are organized and affiliated under a particular company like Fidelity. And Fidelity organizes all of this for all of its funds. Okay. And you'll see how that works soon. I'll be giving you that. In terms of the types of funds, we only really have two types to choose from in terms of mutual funds. The most common is something we call an open-end investment company. This is where the mutual fund company itself, like Fidelity, guarantee they'll sell the shares to you, and they're guaranteed to pay to buy them back from you. Okay. And so that's typically what we deal with, and that's really sort of the focus. Okay. Open-end investment companies are different than close-end because closed-end investment companies don't do that. Okay. Closed-end investment companies, once they sell all the shares in the fund, that's it. It's traded on the stock market. That's much, much different. What we're going to be focusing on and what most people know as mutual funds are open-end investment companies. Money flows into those companies all the time as money flows out. As money flows in, they basically issue new shares in those funds. As money flows out, they buy those shares. The company itself buys them and resells them later. The price of a mutual fund is called a net asset value. That's basically the price of a mutual fund. The strange thing about the price of a mutual fund is that it's the total value of the investments that are in the fund divided by the shareholders in the fund. Well, they can't actually they don't know what the total value is until the end of the day, because then they can say, okay, our investment in Microsoft is worth this much, and our investment in Google is worth this much, et cetera. And they can add all those numbers up at the end of the day. They can't do it during the day because those are actively traded stocks. So they wait till the end of the day, give the total value of everything in it, divide it by the number of shares that fund has, and there's your price. That price is called the net asset value. So a closed-end company works a little bit different there. They only have a fixed number of shares that are available for trading. Once the fund has sold, then it goes to the stock market, basically. And it's open for purchasing and selling. The sad thing about putting these on the stock market is you're subject to supply and demand. So oftentimes the share price isn't really the value of the investments in the fund, but just the supply and demand of those shares at a particular given day, which means a lot of times these closed-end mutual funds are not selling for their exact price. They might be selling for a little bit more, which is a premium, or a little bit less, which is a discount of their real value. We're not going to be focusing on that. We're focusing more on the open-ended. That's the most popular one. So again, the net asset value is explained here in the book. It's the total market value of all the securities that are held in the fund. Okay. Now, funds have some liabilities that tend to be very small. So they're really not a huge impact on the overall price, but they are subtracted out of that value. And then they're divided by the shares. Okay. So total market value of, say, the stocks in the fund will change every day because stock market's different every day. And these funds have, in many cases, 100, 200, 300, 400, 500, 600 different stocks in them, different company stocks in them, depending how large they are. So, it basically is going to be changing quite dramatically every day as the stock market does. Okay. So again, that's what it says. It fluctuates. Funds go up and down because the stock prices of what they own go up and down. And this is the thing. It's only determined at the end of the day. So let's say you wanted to buy a mutual fund today, and you open an account at Fidelity or Vanguard or any of the other mutual fund companies there, and you put $1,000 in there, say, I want to buy the blue chip fund. Okay, great. Well, guess what? You're going to have to wait till the end of that day to know what price you paid for those shares, which is different than how the stock market works, which is different than how EFTs work, which is different than how close-end um, mutual funds work, because the prices are right there on the stock market. You can see them, and that's the price that you'll very close you'll pay. For a mutual fund, you're going to be paying the price of the value, the NAV, which is calculated at the end of the day. Okay, and so that's the quoted price that you see, and that's what you'll get. Okay. EFTs are a bit more dynamic. I like EFTs personally. I like mutual funds too, but I really have gotten quite fond of EFTs. They're basically structured as what's called an index fund. And index funds basically track very popular indexes. And so, for example, the market index is the S&P 500. So this particular EFT called the SPDR S&P 500 ETF, or SPY is its ticker symbol, it tracks the S&P 500 index. So as the market goes up and down, this particular EFT is based on that market. So it's going to go up and down the same. There's another index based on, of course, the Dow Jones Industrial Average. And that's an EFT as well. And so if you wanted to buy the SPDR Dow Jones Industrial Average EFT, DIA is its ticker symbol. It tracks whatever the Dow Jones Industrial Average is doing, that large basket of 30 stocks that you hear about all the time. There are many different indexes. So the NASDAQ has its own index, the NASDAQ 100, for example. So a company, Power Shares, has an EFT, Triple Q Trust, and it basically, whatever the NASDAQ index does for those 100 companies that day, it'll be reflected in this particular EFT. So they're traded like stocks on the exchanges, and they're traded all day long. Okay. The difference is with EFTs, they can continually issue more shares because, very much like an open-ended mutual fund, these things can grow quite rapidly. Okay. And so they are a little bit more dynamic. You actually know the value as the day goes on. Mutual funds, you really don't know the ending value because the trading day has to end. It has to be calculated, and then you know. So what is a little bit better to choose from? Is it a mutual fund is for you, ETFs are for you, or both can be for you? One thing to know is that an ETF will have a very narrow focus. It's going to be focused on a particular market sector, let's say like technology or communications or financial services, for example, or a particular index. And you saw that with the S&P, the NASDAQ 100. There's a whole bunch of indexes there. Whereas mutual funds will usually invest in some cases, hundreds and hundreds of stocks, depending on how big it is. And so it's more diverse. And because it's more diverse, it's a little bit less volatile, you can say. So in terms of ETFs, they trade a little bit less than average compared to the mutual funds because they are traded during the day on the stock exchange. So they're subject to supply and demand issues as well. The mutual fund takes care of the tax management type of issues. So there's nothing there. In terms of costs to the investors in these funds, ETFs have lower costs usually than mutual funds. And that's because it doesn't take a lot of money to run an index fund, but it takes a whole lot of money and a whole lot of expertise to buy lots of different stocks in a company and know when to add, when to subtract, etc. So you're going to be paying for that, and that drives up the costs. Okay. EFTs can be free, commission free if you use a discount broker. Some mutual funds are free. Some mutual funds have a commission to them. So let's take a look at those fees that are involved. Well, because you have a lot of people that are involved in managing and setting up mutual funds, there are fees. So a load, the word load is commission, is a commission. And so there are no load funds and there are load funds. Basically, in a no load fund, there's no commission to buy. In a load fund, there's usually a small commission to buy. So what's a small commission? 2 or 3% of the purchase price. And that's what's called a front end load. In other words, they take the commission up front when you buy it. However, if you don't keep the mutual fund for a period of time and you want to get out, if you get out too soon, you'll be paying a load on the back end, which is when you sell out. So front end is when you buy in, back end is when you get out of the investment. So if you're not really looking at mutual funds for the long term, then and you're thinking I'm going to buy it, wait a few months and sell it, then even if it's a no load fund going in, there's probably a back end load coming out. Because the whole purpose of mutual funds is a long-term outlook. When you go in and out quickly on a mutual fund, you're creating costs, and that increases the fees that the fund has to absorb. And that's why they charge you the fee. So that's it. So per SEC rules, again, the Security Exchange Commission, that government agency that oversees investments, the total maximum load, nothing more than 8.5%, which is not something you want to pay, but that's the total maximum amount for fees that's allowed. Okay. So again, the no load fees don't charge a front end, but if you don't stay in it long enough, they'll charge you a back end. What's long enough? In many instances, it's a few years, and then the load goes away. Some mutual funds actually advertise. They have promotion. They'll sponsor a show. They'll advertise in, they'll do commercials on investment channels. They'll do other things. Well, if it's particular to a company or a particular fund, that promotion is going to be paid for by the investors. And that's what a 12B1 fee is. It's an annual fee charged to the fund investors if there's advertising and promotion. Okay. Doesn't have to be a large amount of fee, but it matters. It matters. And then of course you're paying, you have this professional portfolio manager and analysts that are picking the stocks for you, putting them in portfolio for your benefit. They charge a fee. It's the management fee. And so management fees have to be paid by everyone who's a shareholder. Again, because these funds are quite large, you're only paying literally pennies on the dollar. How much ranges from less, 0.5% to 4% of all the assets that are under management. And regardless of how the fund is performing, these folks have to get paid. They still get it. Okay. So whether things are going well or things going bad, manager just has to get paid. Okay. So overall, there are some fees that are associated with mutual funds. Some are higher, some are lower. Same with EFTs for that matter. There are fees there as well. What's the impact of it? Is it actually it takes away from your return. So if the fund is up 10%, but there's, but 2% of the fund is sucked up for management fees and 12B1 fees and other types of fees, then that 10% return is now diminished to 8%. Right? So it takes away from that return on your investment. Here's some quotations, although I'll be giving you a detailed tour of this on Wednesday. The name of the fund is listed in the first column here. This is a growth fund. This is emerging markets fund here, second one. I don't know what the core could, what this could be. The symbol, every fund, just like every stock, is traded by symbols on exchanges. And so symbols are provided here. Here are the price. This is for one share. The wonderful thing about mutual funds is you can buy fractional shares. It's very normal. That you can't really do that. Well, actually, now you can do that with some stocks because they've been selling them by the slice now, as they say. But it's always been the case for mutual funds is you can buy fractional shares of a fund. So if you only had $100 to invest, under a regular investment, you would only be able to buy 9 shares of this because that would be under $100. But for a mutual fund, you could buy $100 of this, and it'll be 9 and some fractional shares that are given to you in this case. So that's it. The change is the change in the NAV price from the last time it was done, usually the day before. This one was down a penny per share. This one's up 4 cents per share. The year-to-date return, normally speaking, is how the value of those investments in the fund have performed year to date. So year to date is January 1st to whatever date is today. Okay, and that's a percentage return. So as you see, 11.9 is almost a 12% return here, 5.7 almost a 6% return year to date. So from January the 1st to whenever day this was done. They'll always give you a history, 3 years, 5 years, 10 years, always a good thing to look at. So over the last 3 years, so even though this particular fund is up 11.9% year to date, over the 3-year period of time, the last 3-year period, it's averaged 9.6% per year for each of the last 3 years. So it's doing better this year than it had in the last 3-year period, but it's still incorporated in this. And even though this particular fund isn't doing as hot at almost 6% for that particular year, wow, over the last 3 years, it's returned 16.7% per year. This is a per year. So it's really done well over the 3-year period. So it's good to look at the long-term performance of the fund, because oftentimes if it's been performing quite well and it has the same money manager, it's probably going to do well over time. That's traditionally been the case. Know yourself, and you'll know what type of mutual fund is good. That's why I had you do the risk assessment, your risk tolerance, in terms of what type of investments fit your risk profile. If you're more aggressive, you can do smaller company stocks, small caps, and other stuff. If you are a relatively conservative investor, you're probably going to want to stick with more, blue chip type of stocks and bigger companies, et cetera. Well, there's lots of mutual funds to match that. So here's a few here. There are growth mutual funds. So companies that are growing. Aggressive growth is that when you see the word aggressive here, it's really about smaller companies that are growing rapidly. Growth and income is sort of a mixture of companies that are growing quite well, but they've been paying a dividend for a while. That's the income piece. So these are not as risky as a growth fund, because they combine growth with, so companies that are established enough to pay a dividend, so they're old enough to pay a dividend, but they're still growing. So these are a little bit more safe than that. For some conservative folks here, investors, they might want to stick with a balanced portfolio. A balanced fund has stocks and bonds in it, so you're getting a little bit of both. Equity income is stocks. Equity is stocks. Income is dividends. So these are bigger companies that pay dividends. There are bond funds. There are value funds, which are stocks that are considered a good value because they're not overpriced. There are lots of other different types of funds, like a money market mutual fund, which invests solely in the money market. So it's going to be in U.S. Treasuries and bank, interbank loan lending and stuff like that. So it's safe, but it's not going to give you much of a return. Index funds are very popular. So these are mutual funds that invest in the stocks in the index. A sector fund is more specific to a type of industry. So there's healthcare funds, for example, technology, telecommunication, biotech, et cetera, types of funds, banking, oil, energy types of funds, utility funds. So it basically puts all of the investments in the fund in one sector of the economy, one particular area. There are some mutual funds that are considered what we call socially responsible. They basically look for companies that are doing good by the planet and by people. And so these are companies that are committed to more green types of stuff. So you wouldn't have an investment if you're in a socially responsible mutual fund. They wouldn't be investing in things like tobacco use or drilling in oil or anything that pollutes the water. They would be investing in companies that use wind and solar, geothermal. They would be investing in companies that do cleanup of the environment, cleanup of the water, cleanup of the lands. They would be investing in companies that help indigenous peoples or marginalized groups. In general, they do business with them. So those are socially responsible mutual funds. Of course, there are global funds. And you can invest in particular countries, mutual funds that are dedicated to a particular country or a particular region, like Pacific Rim or Europe or South America. Or you can actually invest in a mutual fund that invests solely in a particular country like a China fund or a Germany fund or Brazil, type of fund, things like this. And then there are funds that sort of mix it up. They have some stocks, some bonds, and some money market. And that's what an asset allocation fund is. So if you are an investor in that fund, your investment is in a fund that owns some stocks, some bonds, and some money market funds, and you're going to get the benefit of however they do. So in all mutual funds, however these funds perform, that goes right to you as a shareholder in the fund. Okay, that's the pass-through feature. There are many different types of bond funds that you can, pick from if you're just interested in that. So there's one that's just U.S. government. There are some that are just U.S. government. Some that are in mortgages. Again, government agencies that provide mortgages. You can have a quality bond fund for corporate bonds. So the higher the rating, or you can have a high yield bond fund, which we used to call junk bonds. But high yield sounds a lot better to sell. There are bond funds that strictly do municipal bonds for specific states. There are some that are convertible, some that are short-term, intermediate-term, long-term. I mean, they have funds for everything. You just have to know what you're looking for. There's a fund for it. Mutual funds also provide a bunch of services that are really, really important. One of the things that I think a lot of people need to take advantage of more is this automatic investment plan. Okay. And so you set up an account at a mutual fund. You select a particular mutual fund or two that you want to invest in. Your initial deposit is invested, and then you basically allow them either to deduct from your paycheck or transfer from your checking account on a monthly basis or whatever basis that they can set up for you. And it buys more shares. So they're taking money out of your check or out of your account, and as soon as it hits your account, they're buying shares at the new price. And what that happens is over time, you're buying shares at different prices over time, which lowers your overall cost. Okay, and so that's a good thing. It's like an average cost type of issue here. There are also another thing people should take advantage of is whenever whenever the mutual fund pays interest or pays dividends or pays capital gains, just invest it in more shares of the fund, because over time now those shares are earning interest and dividends and so forth. So over time, it does help that this is how reinvestment. When it is time to sell out, a lot of mutual funds are core for IRA accounts and other retirement types of accounts. Don't grab all your cash all at once, so you can end up with a huge tax bill. Rather, set up what's called a systematic withdrawal. And this you can use with your present value tables, right? You have this amount of money in the fund, and you need it to last for 10 years, and you think it's going to earn 2%. So now you have your present value factor, you divide it into the lump, and this is how much money you can take out every year, and you can divide it into the months. And so systematically take a little bit at a time is what you should be doing. A lot of people don't do that. Most mutual fund companies allow you to switch from one fund to another. Okay. So a family of funds is, Fidelity has, I think, I'm not really sure, it's like 300 different funds, might be even more than that at this point. And so you can switch, you can move out of one fund into another fund within the same company within Fidelity. And so those are conversion privileges. Oftentimes it's without a fee. And so that's good, because then it gives you more choices to move your money without being feed to death over it. And of course, what things you can set up right at a mutual fund company is you can actually set up your IRA at a mutual fund company. And I'll show you how to do that again. Next class, we're going to go to Fidelity to take a look around. Okay. So selecting a mutual fund or an EFT, really a lot depends on what your goal is, right? Is it long-term, retirement? What type of risks do you want to take with that? Do you need the money right away? You can't take that much risk. So, a lot depends on that. So there's funds to match every goal, to match every plan. So it's a matter of deciding exactly what that plan is. And of course, what the objective is of the fund and what your objective is. So you want to invest in stocks, you want to invest only in bonds. What's that particular objective? One of the things is about time. What's the intended use of that money, and how long will you be holding on to the fund before you need it? The longer that is, the more risk you can take. The shorter period of time, can't take much risk. What services are important to you that the fund can provide you? And so obviously there are larger funds like Fidelity and Vanguard and Franklin, for example, that Franklin Templeton, that have great customer services and lots of options for you. In general, for most people, it's okay to start with a no load or low load fund. Okay. Load funds simply have higher costs because there's a lot of selling and promotion. In terms of what we look for in a fund, how it performs, basically you are looking at any dividend or interest income. It has to be passed on to you as a shareholder in the fund. If they sell investments, those gains go to you as well. And of course, as the fund's assets perform well, as say the stock market or goes up, you'll be getting a bigger share price. Now, it is true that past performance does not guarantee future returns, but it's the best indicator we have right now of saying, well, if this fund has returned 10% a year over the last 10 years or even 20 years, chances are it's going to continue doing that. So that is a good predictor. If we could all predict the future, we'd be quite wealthy, but none of us can. But this is one of those things that we can say is like, well, even though I can't guarantee it, it's likely. Okay, we're looking at probability. Go back to your statistics and see your probability issues there. So, again, changes in value occur all the time. It could be because they have gains. It could be because the investments are performing well. We just don't know. And of course, the fund has to report any gains that you have, and so it becomes easier for the fund to calculate and give you tax information. Okay. So there's an exhibit in your book, which is not in the slide, which doesn't make any sense to me. That gives you that summary of mutual fund performance. And again, the income, the distributions from the fund, and the overall returns are very important. And we're going to be looking at those next class in more detail. EFTs ETFs are based on usually an index, and indexes are easier to understand and follow than a particular fund, as you'll see. And so in general, if the stock market, the S&P index is up 12% this year, and you're in an EFT that follows the S&P, you're going to be up 12% this year, because that's the only thing the ETF does is follow it invests in the index. Index are made of a group of stocks that create an index. So you're investing in the same exact group of stocks as the index. No more, no less. So whatever it's doing, you're doing. Okay. And so there are different statistics that measure things that we'll talk a little bit about, including its primary statistic. We'll take a look at this next time. Okay. The primary statistic basically is, the ETF is only, depending on how big it is in terms of the amount of money that's there, could only buy a certain amount of shares in every stock in the index. The S&P 500 is 500 different stocks. So how much they can actually invest depends on how big the ETF is. Large ETFs invest fully. But sometimes they can overinvest in one stock versus the other. It may not be an equal distribution of shares. And so those statistics, it should follow. Like I said, if the S&P is up 12%, it's very likely that you're going to be up 12% if you're in an ETF that follows the S&P. It's quite possible you can be better than that. Depends on the R squared. It's possible you could be a little bit worse than that. So even though the S&P could be up 12%, it's quite possible you could be up 13 or 14%, because the distribution of companies in the ETF slightly favors other companies that did well. It could also be that your ETF did a little bit less, or the market was up 12%, but your ETF was only up 10. Why? Well, because it probably was invested in slightly different amounts in stocks that may not have performed as well that year in that index. So it is one of those types of things. There is a correlation there. and not to get too heavy-handed on the stats. That's usually how it's looked at. Fidelity has a fund called the Contra Fund that focuses on this type of thing. You don't have to worry about how a yield, how to do that, but in essence, it is there are dividends and capital gains that are distributed. So that's going to be added to any gain that you've mentioned that you've gotten over the course of owning the fund when you sell it. And so that's going to provide you for a higher approximate yield. So the simplest thing you can do is start early. Right? By age 25, it's really important to be invested. You know, have your own IRA, or if you have if you have a job and a company offers a 401k, involved in it. Get involved in it. And this researcher, famous as he might be, basically you can do quite well, in his opinion, with just 3 mutual funds. Okay, which ones? Or ETFs? A total stock index fund, an international stock index fund, and a total bond index fund. He thinks with those, you'll be fine. You don't have to, I don't think if you do have to calculate a return, it's going to be quite simple. You don't have to do the whole 9 yards. So if you buy a mutual fund at 100, you sell it at 200, and it gave you a $10 dividend, what's your return? 110 divided by 100. So you made a good return. But nothing complicated. If there is a question, no, nothing on ETFs. Just know what they are. So that's kind of the overview. Again, I want to take you next time directly to an investment company like Fidelity and show you how an account would be opened, for example, and then look deeper into the funds. One thing everyone has to do is understand that there's a prospectus for every fund, which means that prospectus has to be read by the investor before they invest. It does go over all the information that we just covered in terms of the objectives, the fees, things like this. I'll also bring you inside a portfolio or two so you can actually see what a mutual fund holds and how they get its value. Okay, so we'll do that next time. Questions?